Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. Markets are really just edging sideways at the moment, very calm in fact. Perhaps we're seeing a return to relatively normal market conditions after what has been a blockbuster of a year. And certainly the last several months have been extremely volatile, even within daily ranges, let alone the overall movements of equity markets in particular, but also currency markets. So some calming down of markets would be appropriate as we head into the holiday season, obviously, for many around the world. But I do think the move we saw in New York yesterday was very much in equities, was very much about institutional traders really just taking out all the stops, breaking that very clear support level I had been highlighting, and the market taking out the stops to the downside, then immediately coming back. And really, it wasn't about fundamentals. That's what the move on the day was about. So now we're left with the market moving back into the range that it was in previously for the previous 3 or 4 days. And we're going to now begin to see really the determination of, are there more buy the dip people out there than there are funds that are getting redemptions from investors and are being forced to sell. So I really see it as that kind of tug and war in the US equity market at the moment, which will decide the next near-term trend to medium-term trend from here. The economic fundamentals for the US continue to deteriorate, but overall the price action is becoming more encouraging. So the equity market bulls do have a stronger argument now than they've had all year. As you know, we've been bearish from the first week of January and have called this extremely right and accurately. And I do think there could be still further downside. You know that I've been very bearish of late, but I'm willing to accept that some of the price action to the upside is a little bit supportive. What I'd suggest to you is that the range of the US 500 index over the last 2 to 3 days, watch for a break of that range, and I mean by that including yesterday's low point, because the market sold off several hundred points on the Dow Jones and then bounced back. So just look at the last couple of days of trading. That range is probably going to determine the medium-term outlook actually for US equities. Overall, the economy is in trouble, so I would think even if we get further significant upside in US equities over the next 1 to 3 to 4 weeks, the bigger picture could still be bearish. However, we do need to respect price action and go with that kind of a move should it occur. Now, one of the big developments over the last 24 hours is Japan's inflation rate has really taken off to the upside. It's a big leap, the biggest in 32 years. And that is definitely going to push the Bank of Japan for interest rate hikes in an ongoing fashion. They want to nurture their economy, but they also want to head off any of the kind of crisis inflation that we continue to see in the United States, Europe, the UK, and also even in Australia. Inflation continues to move higher rather alarmingly. So the Bank of Japan will be hiking interest rates. Now, the initial market response in the yen rate, the dollar yen rate, is reasonably muted. I would be watching for a break of the sort of 139.5, 140.5 dollar yen range to really begin to indicate whether the market, major hedge fund managers, etc., are going to take the view that this data is particularly worrying. It means the Bank of Japan will be raising interest rates, which will continue to subdue and hold down the Japanese economy, or it's perceived, and I think that's kind of how most people are reading it at first on the day, or is it a reason to buy the yen because there's been still so much selling that has not been fully unwound that has occurred this year, and therefore the yen could begin to pop to the upside. So we'll just use that technical range, 139.5, 140.5, as an early warning indicator of which of those two arguments could be starting to win out. and it would probably be a good idea to go with the trend development out of that range, whichever direction it is in. Given the volatility of markets these days, though, you're going to have to be prepared to get it wrong on the first attempt and then go again on a second attempt. There's so much false break activity in these markets these days because the institutional traders and dealers can see where all the stop loss orders are. They know they'll be outside those parameters, so whichever direction it's easier to push it in, they may well push it in that direction, set off all those stops, then the market will immediately reverse, and you need to be prepared to go with the market in the other direction break as well. So don't give up on that idea of that 139.50, 140.50 range as an early indicator, even if it's broken that range once before. So keep an eye on that. I tend to think, you do have the Bank of Japan smoothing the market of late, and I do think a lot of people have speculatively positioned against the Bank of Japan, and therefore this might be one of those occasions where the Bank of Japan actually wins on the day, given that they haven't previously won when they've tried earlier to smooth the market. One of my favorite things in trading interbank with big investment banks around the world was to always go against the central banks. So in saying to you, it might be time to go with them, it depends on the fundamentals, but if there is the prospect of the Japanese economy holding firm while the Bank of Japan raises interest rates, I would tend to be on the long side of the yen from here. I do think that throughout Asia, Asian currencies from here will fare far better than the euro or the US dollar. Certainly the economy, of Asia will fare far better than that of Europe, the UK, or the United States. And that should support their currencies, particularly against the euro and sterling, I would think. I do believe the US dollar can still rally one more time against the euro and sterling and even the Australian dollar, but it's going to become more difficult against Asian currencies. So Malaysian ringgit, Singapore dollar, and the yen, I'm looking closely at buying those currencies for perhaps a 3 to 6 month trend to the upside. They just haven't broken quite as cleanly enough in terms of the technical price action yet to confirm and encourage that view. But well worth keeping an eye on, particularly after this very high inflation leap in Japan today to 3.7%. Thank you very much. Clifford Bennett, Chief Economist, ACY Securities.